Morning to you all. Happy sunny morning. Lovely day out there. Horrible day yesterday, but lovely day today. Depending on where you are, of course. If you're on the west coast, all the way up to Dumfries and Galloway and up to Sutherland, it's a little bit damp. But anyway, if you're sort of in the southeast, on the east side of the country, lovely day. Yeah. Morning to you, Owen. Yep. Michael, Neil. Yep. Good to have you all here today. Look at the FTSE. Wow, what a move, eh? I say what a move. It's sort of sadly depressing in a way that we're potentially going to be losing Anglo-American from the FTSE 100, one of our big companies. And you might think, well, we losing it, or it's just been absorbed potentially by BHP, but they're going to be selling it off, breaking it up, whatever you want to say. But it looks like investors are really expecting others to enter the fray. Notably Rio Tinto and Glencore. So it's likely that BHP will be upping their bid. Anyway, that's the FTSE, but record territory, lovely. US equities, quick look at them. S&P 500, the S&P 500, that's the main index that almost all fund managers follow. That and the NASDAQ. It includes the top 500 companies in the United States by market capitalization. What do I mean by that? What they're worth. Believe it or not, the Dow Jones is not calculated that way. It's on a price-weighted index. So the higher the price of a stock, the greater influence it has on it, regardless of its capitalization. So here we go. Equities, yeah, they've done pretty okay last week. Certainly recovered some of the losses over the last 3 weeks. A lot better than expected results. Alphabet, Microsoft, what are these? The $2 trillion companies, the ones that I think in aggregate, the rally in Alphabet and Microsoft equated to $250 billion worth in value. It's just, we're in another world in the UK and in Europe, actually, yeah. Anyway, FTSE, as we've just been discussing, was pushed into record territory again last week and record territory this morning following that mining giant BHP, used to be called BHP Billiton. They approached to buy Anglo-American, who've already, as I'm sure you all know, have rejected the offer. But unfortunately, I think the writing is on the wall for Anglo, and it looks like BHP wants to get hold of their copper assets, which is very key to the artificial intelligence boom and the whole rollout of all that sort of electrification of stuff and EVs and God knows what. So there we go. UK markets, as I say, both stocks, BHP and Anglo, had a bit of activity. Anglo, not surprisingly, rallied quite sharply, up about 20% last week. BHP actually didn't fall that much. Normally the company doing the acquisition gets hit a bit, but their shares are only about 5% lower. They're going to be paying in their own stock, and it just looks like it's been rejected by the board of Anglo, saying it significantly undervalues the company. Of course they're going to say it. It basically means we want you to pay up more. Anyway, Anglo's price was up about 20%, as I say, and I think investors expect other rivals to enter the fray, and I've already mentioned Rio and also Glencore are likely to table rival bids, which is going to push BHP into increasing their offer. Yeah, anyway, but analysts, not me, I don't really follow it particularly closely, but analysts are saying that Anglo-American is going to struggle to survive and could end up being broken up, really, which is basically BHP taking the cherry that they wanted and then hiving off the rest of it. Anyway, what's clear is that the deal, if it is successful, will result in another heavyweight Anglo. Gosh, and I've been doing all of this since the late 70s in the city or in various guises, various roles. And I remember trading it way back. Be a shame to see that one go, that's for sure. Anyway, don't wish to sound too depressing. It's like losing an old friend, isn't it? Anyway, US markets, having a look at S&P 500 here, they've been burdened, I suppose you could say, by increasingly hawkish interest rate expectations over the past 3 weeks. What I mean by that, hawkish, is that data coming out is suggesting that the Fed won't be able to cut rates. Persistent, sticky inflation that has really caused a complete rethink about what the Federal Reserve will be doing re-interest rates. And you can see my mouse hovering over the CME FedWatch tool. For some of you who've been with us for years and years, especially since the start of the year, you will know that expectations at the beginning of the year was that the central bank in the United States, the Federal Reserve, and their rate setting committee is called the FOMC. We live in mnemonics here, but there we go, the FOMC. We have our own rate setting committee here at the Bank of England called the Monetary Policy Committee. We shorten that to MPC. Anyway, the FOMC investors or forward rates are saying that the Federal Reserve is only likely to start cutting rates in November, 7th of November. Interestingly enough, that's a day or two after the presidential election. So poor old Biden is not going to get any kicker from the Fed cutting rates before the election. It's going to happen after the election, according to this. That's not written in stone. No. It's changing literally day by day, hour by hour. But remember, at the beginning of the year, the markets were just so stupidly bullish, talking about rate cuts, 7 rate cuts. Well, we've got the first meeting this week on the 1st of May. So what is that? Wednesday. No chance of any rate cut. Sorry. June the 12th, no chance. 31st of July, the next meeting after that, still only a 1 in 3 chance. 18th of September, after the summer, it's sort of 50-50, but it's not a certainty. So only when you get to November that there's an odds-on probability. There's only 31% chance of it staying at 5.25%. It's changed so much. So what does it all mean? What does it mean for the markets? Well, remember, lower rates are good for companies, good for consumers, the way interest rates trickle down, lower mortgage rates. Yeah. But actually, guess what? The US is in a different sphere to the UK, to Europe, and other developed countries, Australia, New Zealand. The US has got an incredibly strong economy, and it's also got stickier inflation. And the problem with stickier inflation, it basically means that the central bank, the FOMC, the rate setting committee of the central bank, has to basically look at that inflation and say, well, it's not approaching our target. The economy is particularly strong. We won't be cutting rates. And that's basically reflected in what's going on here. And that has indeed affected the US dollar. The US dollar has rebounded. It has affected stocks over the last 3 weeks. The markets, the US stock market, it's incredibly resilient though, incredibly resilient. Especially with the Magnificent Seven doing what they do. They when they go up, market goes up. And that's what happened at the end of last week with the first quarter earnings for the likes of Alphabet, which owns Facebook and not Alphabet. Alphabet. No. It was Alphabet and Meta, I should say. Yeah. But anyway, strong results across the board. And Apple is the only one that's struggling a little bit. Yeah. Okay. And then we had data last week, just looking very quickly. We had something called the GDP data reading. This is something that disappointed the markets. This is the value of all goods and services produced in the United States in the first quarter. And you think, wow, they've already got data on that by the 25th of April. They don't have much. They've literally got 25. They've got about 40% of the data in then. And this is what's called the advanced reading. They have 3 readings. The advanced reading precedes the prelim reading, which is a bit weird, really. Prelim, you think that would be the first. Anyway, the advanced reading, it is subject to revision, but it's way, way lower than expected. normally this wouldn't attract much attention, but it was so far off pat that it did cause a bit of a ripple. And actually, all the big sort of traders who are looking for rate cuts from the Fed thought, yeah, that means the economy is not doing as well. That means they can afford to cut rates. And then you get something called this advanced GDP price index. So this is the effect of inflation on those numbers. And because it's all very well saying GDP's gone up because this many goods and services have been sold in value, but actually a lot of that is accounted for by inflation. Anyway, the inflation number, 3.1%, was higher than expected. And I think that's, it's like a broad inflationary indicator, really, which basically means inflation is running hotter than the Fed would like, whilst growth, basis this first quarter reading, is much lower than forecast. And yeah, it caused havoc in the market, said Owen. Yeah, it did. Yeah, it's something that we don't normally react. We being traders, investors, don't normally react to GDP data because it's telling us what has happened, Owen, not what's going to happen. But because the inflation, the advanced GDP price index was higher than expected, anything that is potentially saying that the Fed won't be moving rates or will be moving rates will really hit the markets. And I think this data, to a certain degree, could signal stagflation as prices remain far stickier than anticipated, certainly anticipated at the beginning of the year, and pressure on the FOMC, committed to hold rates at current levels for some. So the market wants rate cuts, but the Fed is only judged by how it manages price action, price stability, which is inflation, and also unemployment data and the employment picture as well. Anyway, so this CME FedWatch tool says it all now. So the chances are of a rate cut have been pushed back to 7th of November. Honestly, you go back even 10 weeks ago, that has changed, significantly. And as I said, it's not something that Joe Biden wants to hear. He's banking on some good news, because one of the criticisms, this is so bizarre, one of the criticisms of Joe Biden's administration is it hasn't managed, is on the economy. On the economy, for God's sake. What is going on there? Yeah. Maybe they just don't like old people. I think Trump, if he gets into power, will be the oldest president as well. Yeah. You get it. Yeah. Anyway, what's interesting, I did actually pick up on a report from the Financial Times. The options markets now are pricing in a 20% probability of a rate rise over the next 12 months. Yes, you heard it, a rate rise. But of course, that's bound to happen, because if they're not going to be cutting rates until November, there's bound to be a probability of a rate hike. It is less likely, improbable at the moment. 20%, 1 in 5. Yeah, you'd say that. And obviously, just 10 weeks ago, that would have been unthinkable. But bond yields, do you remember we talk about bond yields, something that the sort of reflects what people think, what investors, traders think about inflation. So if I go to market data here on the Financial Times, have a look at bonds, and just click on the US yield curve, and we can see how the 2-year bond, so I'm just hovering over the 2-year, we've got 3 lines on this graph. One is the current price, which is the turquoise price, which actually is very close to the 1-year one as well, and then the brown one, which is a month ago. And you can see how much yields have increased. So a month ago, yields were at 4.99%. Now, currently at 4.99. They were around 5.01, 5.02 at the close on Friday night, and that's a 5-month high. And that's just I guess investors confronting the risk of persistently higher than hoped for inflation. Yeah. In fact, yeah, a month ago, a month ago, in fact, over a month ago, about 6 weeks ago, they're down around sort of 4.6% yield. So just important to understand that everything is shifting higher, and this is a cost to the businesses, cost to the consumer. But that's how you dampen down inflation. It's called monetary policy. You control the supply, velocity, and supply of money in the system. That's how you do it. Well, that's how they do it. That's not how I do it. Okay, currencies very quickly onto the euro, dollar, sterling against the dollar, dollar yen. Sterling was a standout one again. Look at sterling. It's volatile as hell. I think traders absorbing the differing views from the monetary policy committees. Remember, that's the committee at the Bank of England that sets interest rates. There's the economist Hugh Pearl. He's the one that replaced Andy Haldane, and he's the bank's chief economist. He said that he would be relatively cautious about cutting rates, which you tend to think, well, he's the economist, surely he'll be advising everyone else on the committee. That's not quite how it works. But Megan Green, an external member of the Monetary Policy Committee who was appointed last July, an American lady, very, very astute, very, very, I think a very valuable member of the committee, actually argued that the bank should not cut rates until there is much stronger evidence inflation is under control. And I think that sort of contrasted with comments by another member of the committee, a chap called Ramsden, who's the deputy governor of the Bank of England, who said earlier this month that he didn't see any need to see any more evidence to vote for a rate cut. So he's saying, let's have a rate cut. Andrew Bailey, the governor of the Bank of England, said the same thing. Anyway, I mean, the reason why I'm dwelling on this is a lot of us are based here in the UK. We have lots of customers outside the UK as well, but a lot of people here listening in the UK will want to know what's happening with interest rates. Ironically, at my stage in life, I'm happy for interest rates to stay up, but I've got 3 daughters who would be screaming at me now, for God's sake, cut the ruddy interest rates. Anyway, that's how it all works. It's down to a committee that assesses all the data as in hand, and it's likely that inflation will fall to the 2% target when the energy price cap is taken into account. And then inflation is expected to tick up from there. And I think that's the risk here about cutting interest rates. Anyway, it's likely to happen, if you want to know, probably at the next meeting on the 20th of June. And then there's not one in July. If it's not 20th of June, it will be the 1st of August. And the markets are anticipating 3 interest rate cuts in total by year end. Other economists, other advisors, etc., I think Capital Economics, a very good group, very switched on bunch of people, believe there's going to be more than that by year end, and that rates could end up near 4% by year end, which would be a 1.25% cut, if I've read it right. Yeah, euro. I've just asked a little bit about the euro. We don't have a ECB monetary policy meeting until the 6th of June now, so nothing in May, and it's likely we'll have to wait until then. But it looks like already inflation data, we just had some data out this morning ahead of the data tomorrow for the flash estimates on core CPI, already weaker than expected. Yeah, I'd say US markets are expecting no change in rates, and I think the discussion will be helpful, I think, to determine, more accurately when rates might be cut. And in the Eurozone, investors, as I said, they're waiting until the 6th of June, but already Christine Lagarde and the committee have said that they're likely to be cutting rates at this next meeting. But we've got to wait. Yeah, 6th of June. It's 5 weeks away. So finally, just before quickly running through the numbers, gold. Yeah, gold sort of, well, it's succumbed to the rally in the US dollar as analysts reduce the expectations for rate cuts. Remember, a stronger dollar, not good for any dollar price commodities. Gold has sort of blown that out the water to a certain extent in the last couple of months. And its fall is not surprising, but gold has been particularly strong on the back of Chinese central bank buying, that's the People's Bank of China, and also China, retail China buying. So there's been a lot of that. Is it surprised to see a fall? Of course it's not. I'm surprised it only fell what it did, really. I mean, the rally since, I don't know, sort of mid-Feb, been $400. That's a very, very modest correction last week, quite frankly. I still think gold probably looks a bit more, looks vulnerable to further pullbacks. Maybe there's no obvious stopping point really until it gets back to the sort of the 2150 level for the next area of support. Quickly onto oil. Yeah, it rebounded modestly, but you can see where we are higher highs and higher lows, and that's the definition of an uptrend. So obviously the challenge will be to take out this level of resistance up at 90.85. But it's all sort of in balance, really, isn't it? I think it rebounded last week, oil having fallen the previous week when Israel and Iran appear to pull back from the brink of an all-out war in the Middle East. And I think global macro events, OPEC supply decisions, they balance the less optimistic demand forecast, really. But I think the risk is still tilted to the upside. Yeah, that's for sure. Okay, calendar, quickly. Not quickly, I would say quickly. Why would I go through it quickly? Monday, so we've had, has the German one come out yet? No. All day. I never know what all day means. Well, we come out anytime. Yeah, we'll make it up as we go along. Anyway, the Spanish flash CPI is less than expected at 3.3%. Already the numbers look like they're going to be lower than consensus. So the overall core CPI that's published tomorrow on Tuesday will be a focus of attention there, because that will affect obviously what the ECB do. It'll affect the euro, it'll affect Eurozone assets as well. So it's something we need to watch reasonably closely. Overnight, we have Chinese or data from China, I should say, manufacturing and services PMI data coming out. Non-manufacturing, it means services, by the way. It's a slightly longer way of saying it. Don't know why they say it. Anyway, signs of activity is picking up in China. Not if this data comes out, but a bit of a pullback from the previous month's report. But Beijing seems to be focusing on manufacturing, really, as the property sector woes continue to drag on the economy. But I'm sure the likes of Germany, the powerhouse in Europe that really depended on a lot of demand from China, would love to see that improve, but not yet. But the signs sort of looking more positive than of late. Then the data I just mentioned, inflation, core CPI, the inflation data, core, removing those volatile components, the energy and food components. The first reading of the CPI in the Eurozone bloc with consensus at 2.6%. And the headline at 2.4%, headline being the one that includes all the data. But unlike the US, which is a far stronger economy, the Eurozone is likely to see inflation at or close to the 2% target in the coming months. So that's why forward rate agreements are saying, yeah, we will be cutting rates here in the Eurozone, like in the UK. But the US, different kettle of fish, far stronger economy. Even with a slightly downgraded GDP report last week, it's in a different sphere compared to the UK and Europe. Wednesday, yes, consumer confidence is a good point. Yeah, that CB, that stands for Conference Board Consumer Confidence. So stickier inflation, I think, could start to wear down the consumer. I'm not surprised to see the number dipping a little bit. The last retail sales data that we talked about at last Monday's workshop suggested otherwise. It was quite strong, but I think almost all data suggest stickier, persistent inflation is going to be preventing the Fed from cutting rates, and that's going to wear down the consumer. Anyway, that's CB consumer confidence. Wednesday, yeah, it's a holiday. Well, it's a holiday because it's May Day, 1st of May. We don't have, we do it at the beginning of the week. It's actually quite disruptive. I did work out in Germany for a while, and having a day off midweek, well, guess what? Everyone takes the Thursday and the Friday off. It's like, why didn't you just do 3 days off anyway? So, bank holiday across almost all of Europe on Wednesday, so all the markets will be shut. We've got the ADP non-farm employment change. So that term non-farm, let's just call it core inflation. It excludes the volatile component being the farming sector, which is a very seasonal employer. Resilient, I'd say, is a good description. 179,000 new jobs in April. Less impactful than the one on Friday, the non-farm employment change from the Bureau of Labour Statistics, but nevertheless, the market does follow it. It's just it has in the past been quite volatile, and I think ADP have tried to work out a way of smoothing it out because it becomes a bit unreliable. And then we got the key event of the week. We've also got, actually, I should say, manufacturing PMI data. In a way, it's sort of lost in the FOMC decision. So I think I'll focus on that. The FOMC policy meeting. So this is the interest rate setting committee, the FOMC, making their decision known on interest rates. Clearly, we're expecting no change. Interest rates to stay at a band between 5.25% and 5.5% in the United States. Yeah, there's the press. First of all, the market will be reading the statement that's published by the committee, and then we've got the press conference when, you know, Jay Powell will be letting us know what the Fed have been discussing and how the decision was made, and anything that could affect future rate decisions will be jumped on. So it could be a little bit lively, 7:30 possibly. So US dollar, US assets, global assets, really certainly in the developed world. So we'll all be very sensitive to what this number is in the United States. So yeah, well, a lot of you will maybe, if you're for those who are day trading, you'll need to take note of that. But obviously, for end of day, it is what it is, and you'll be making your decision later on that evening. Thursday, here in the UK, not listed here, we got local and mayoral elections in England and Wales. I think the threat of a challenge to Rishi Sunak, if the elections are bad, I think it remains, but I can't believe they'd do it. I mean, it'd just be nuts, quite frankly. It would look like and I sort of describe it as an act of self-harm for the Tories, but they're in for a drubbing now, or this week, and in for a drubbing at the general election, whenever that's called. Although I did meet some people, politically connected people, yesterday lunchtime, and they seemed that suggested that it would be far from a landslide, as things are likely to improve for the economy before then. Anyway, that is probably rose-tinted spectacles, etc. On Thursday, that's pretty much it, really. Friday, we come on to, there are two key events in the month that we as traders focus on. Interest rate decisions. We've got that one in the United States this week, probably the most important interest rate decision in any calendar month. And also the second most important one is non-farm employment data. This is because the US is very sensitive to employment picture, because the Federal Reserve, the US central bank, one of their mandates is to maintain full employment. So obviously what happens with the employment data is going to affect Fed thinking. Anyway, there's been some pretty wild gyrations over the past 3 months with that, wasn't a blowout number in February, I think it was. And the actual data has seen a sort of a reasonably buoyant employment market as growth in the US remains higher than other developed economies, as I've just been saying. You know, good for the US, but the growth and sticky inflation has resulted in, the likelihood of a rate cut not really happening for quite a while, and the possibility of a rate rise. Anyway, you can't have a strong economy and have interest rates coming down. You can't have a strong economy and weaken and lower inflation. That is the problem that the US is confronting. Yeah, lucky us, we don't have any growth. We don't have any inflation. Ironically, you know, we were a candidate for stagflation, no growth and inflation. But certainly it's been a modest surprise to see inflation come down as fast as it has here in the UK. And then finally, the ISM services PMI data, slight improvement there, just underlines how strong the US economy is, isn't it? Anything above 50, that sector is expanding. So nicely higher than 50 at 52 is the consensus there. That's it. That's it. Yeah, 20 past. I seem to be hitting 20 past quite regularly these days. I'm going to find out why I can't appoint myself as a presenter and not have that rather delayed changeover. But thanks for listening. All been a bit quiet, but I hope you're all listening intently. Yeah, I always like it. Everyone suddenly replies, yes, of course we are. Yeah, thanks. Yeah, I appreciate that. Peter, yeah, that's kind. Yeah, you have a good week, Paul, and I'm off hiking up in Scotland on Thursday and Friday. My day's off, but I'll be back on Monday to run through it all again. So yeah, have a good week, Edward. Thanks so much, and you, Dom. Have a good rest of the week. Good luck with the markets, and yeah, we'll catch up again 8 o'clock Monday morning. Bye for now.